main driving factor here is the money supply. Again, we have two factors on the side that are very key to the near-term inflation outlook. One is oil, and the other is the U.S. dollar. I discussed oil, touched upon the dollar, and the dollar is probably the key here in terms of how and when things break. As dollar selling intensifies, you're going to see extreme effects in our system in terms of inflation and disorder in the financial markets. Because what lies ahead, but without getting at the moment into the details of how severe the economic downturn is, and it is severe, we're in a circumstance where the new administration has promised a very substantial stimulus package. And I hope it works, but there are going to be some major problems with it. The Congressional Budget Office a couple of weeks back estimated that the federal deficit for the year 2009 was going to be $1.2 trillion before accounting fully for the cost of the wars in Iraq and Afghanistan, and before accounting for any funds spent on the stimulus package. If we go back last year, in 2007, the deficit was something like $454 billion. These deficits, the actual cash spending, which is what the government reports, have to be funded in order to make the payments. And over the last 6 years, generally, about 80% of the net issuance of the U.S. Treasury has been absorbed by foreign investors. With the current crisis, you've seen a lot of pullback and commentary about foreign investors not being so eager to buy new U.S. treasuries. The same is true in the domestic market. You have no meaningful yield. It's again, you can make more money going out and buying the goods you're going to need for the next 6 months than investing it in a treasury bill. So the problem going forward is that the U.S. Treasury is going to find it increasingly difficult to sell the Treasury securities that it needs in order to fund the government's operations, to fund the bailout package, to fund the wars. And one of two things happens. Either because these funds are competing in the domestic markets for liquidity, you get a very sharp rise in interest rates and a collapse in stock prices, which already are suffering, or the Federal Reserve becomes the buyer of last resort for the U.S. Treasuries. And when the Federal Reserve becomes buyer of U.S. Treasuries, it is monetizing the debt. It is just creating money. And it is that monetization of the debt which again will severely spike money growth, leading to much higher inflation this year. I thought we'd be seeing much higher inflation when we talked back in May. At this point than we are now, I was not foreseeing a collapse in oil prices, which can give you short-term massive shifts as has happened. But looking forward, I still think we're going to see double-digit inflation as the government reports it before the end of the year, and that's assuming that it doesn't evolve into hyperinflation, which is still a risk. So my answer is I'm still looking for inflation.
Well, one of the questions that I wanted to ask you, John, and we've talked in the past about the plunge protection team or the President's working group on the markets. Do you think that it's possible? I mean, obviously the government knew what they were facing. They knew the Fed was going to bring down interest rates, and they knew we were going to have these stimulus bailouts, whatever you want to call it. Do you think that it's possible that the government went out and intervened and bought dollars to crack inflation over the short term? Because if there was speculation in the oil markets, if you started to strengthen the dollar, you knew that would bring it down. Is that a possible scenario?
Not only possible, but I think it's likely. What happened, you go back actually to, I guess it was last March. Time keeps passing very quickly here.
It does.
with Bear Stearns. You had the dollar at pushing new lows. You had gold at an all-time high. You had oil high. I think it was may have been a little later that it actually hit its all-time peak. No, I think it was, they all took place about the same, middle of March. In order to try and bring the system under containment, the plunge protection team, as you call it, and that was a nickname created by the Washington Post for the government, for the president's working group on the markets. I believe it's likely that they, in fact, there's some direct evidence that they at least intervened directly in the currency markets, and they probably intervened directly in the oil and the gold markets. That they have done that before. I can remember Alan Greenspan, who once headed it, making a comment back at the time of the onset of the, I think it was the Iraq War, current Iraq War. Everyone knew it was coming, but they were afraid that when the fighting started that it could be disruptive to the markets, and the purpose of the plunge protection team was to maintain orderly markets. So with a heads up as to when the attack was coming, they went in and they sold oil, they sold gold, they sold, they bought the dollar. That they intervened to make to counter the impact of the war, and this is no different. So, I mean, I'd say the odds are very strong that something like that happened. Then as the crisis deepened, you had other factors that kicked in. It was not just intervention, although the intervention probably triggered the initial move. You have seen, and in fact still are seeing, the greatest financial crisis the world has ever seen. The companies were in circumstances where they were caught on the wrong side of contracts. They had to liquidate different positions. They had to wind down derivatives contracts, and that often required actually holding dollars, which they would not have held otherwise, or were forced to buy dollars as part of the liquidation process. And for a while, that provided some support for the dollar. As we got towards the end of the year, you found that beginning to disappear, and the dollar selling began to intensify. And I think we had another round of central bank jawboning and intervention the last month or two, as the crisis has again begun to intensify. It's not over, but the underlying fundamentals here are actually very miserable for the dollar. Whatever the Fed has done to save the system is not cost-free. The cost here is inflation. That's a big negative for the dollar. Big negative for the dollar in terms of our economic activity, much weaker than, with our major trading partners. Mr. Obama is a new president, and that may be helping a little bit, but that's only short term, because the problems he faces are the same ones that George Bush faced, and that is they don't have the money to bail out the system the way they'd like to, without otherwise financially disrupting the system.
For the rest of this great interview, visit our website, www.stockshotz.tv. That's www.stockshotz.tv. Thank you for listening.